Hi everyone, and welcome to today's webinar. My name is Kiara Simmons-Wood, and I'm the Events Planning and Marketing Coordinator at Charity Digital. I'm going to be your host for today's session and would like to give you all a very warm welcome. So today's session on where to start with ESG investment for your charity will be delivered by Guy Davies, co-founder of Charity Intelligence. And the session will define ESG and explain how ESG investing can benefit your charity. Today's session is also sponsored by Charity Intelligence, a charity dedicated to helping other charities find the expert advice they need, all for free. Now, just before handing over to Guy, I just want to share a few house rules, exciting updates, and pointers for today's session. Firstly, I'm very excited to let you know about Charity Digital's new single sign-on function. Charity Digital currently has two separate websites to deliver our services. The website are dedicated to our content, which is where you would have registered for today's webinar, for example, and Charity Digital Exchange, our transactional website dedicated to product purchasing, discounts, and validation services. Now, registering for both websites is completely free, and you can now access the Exchange website with your original Charity Digital login credentials, and you can contact us via email, phone, or live chat if you have any questions. Now, on to today's webinar. The session is currently being recorded and will be uploaded to watch on demand within a week's time. The slides and other resources will also be made available to you by the end of the day, and closed captions are available, and I'll shortly share in the chat how to enable these. During the webinar, please ask a lot of questions in the Q&A section for Guy to address at the end of his presentation, and feel free to share any other comments, experiences, or top tips in the chat section. If there's a particular question in the Q&A section that you would like answered, you can also upvote questions, and I'll be asking these to Guy first. Finally, if you encounter any sound or image issues, please let me know in the chat, and I'll do my very best to get the session back to normal as soon as I can. And without further ado, let me hand over to Guy.
Well, good afternoon, everyone. I hope you can see and see me and see the screen in front of you. Thank you for joining us this afternoon. I hope I'm not going to give you too much indigestion for your lunch. The subject we're going to talk about this afternoon is obviously where to start with ESG investment for your charity, which I think probably to some people is quite a dry subject. And I'll hopefully bring it to life and make it relevant for all those of you who are investing on your charity, on behalf of your charities. And I suppose the other thing I should start by saying that I appreciate there'll be a mixed level of ability of people. There may be some people on the call who are sort of fairly expert about this, and there are others who are absolute beginners. So my aim is to sort of pitch it at a level that is hopefully acceptable and understood by all, but by all means ask questions. So my presentation this afternoon is quite full. There's quite a lot of information here, but don't let that put you off. As Kiara said, you will be getting the slides, so you will be getting the information. Don't worry about that. But what I'm aiming to do this afternoon is to start from where charities generally begin if they're investing their assets and reserves for their beneficiaries, and introduce this whole complex or issue around social investment and ESG. A little bit about us. Charity Intelligence was set up about 7 years ago. As Cara said, we are here. Essentially, it's a website to signpost charities to professional advisors. So if you need assistance with investments or legal, accountancy, insurance, we have around about sort of 75, 78 firms on the website that are open to help and advise you, and it's absolutely free for charities. I myself spent approximately 25 years in the investment management industry before setting up Charity Intelligence, investing money for charities, and I've spent the last 20 years plus as a trustee of charities, so probably have quite a lot of similarity to a number of you on the call. So getting into the meat of the subject, essentially why do charities invest? And the bullet points here really give you sort of the clear ideas. So clearly your main aim is to, if you are investing money, is to do it in the line of your beneficiaries. So you really need to sort of think about your beneficiaries when you're investing. But most of the time, if you have reserves, that most charities have got financial reserves, your aim is to spend during this year, next year, and the year after, but have enough in the pot for future beneficiaries in the years to come. And obviously your main aim is to maximize the return, but I'll come on to that in many senses. And this whole element of ESG is much more prevalent now than it has been for many years. But ultimately, this whole issue of duty for care for your beneficiaries and your donors is vitally important. But in order to do that, in order to beat what is probably most people's problem, which is inflation at the moment, investing is unfortunately the net result of it. A lot of charities will actually sit on cash and not invest, as in longer term investments, and that's perfectly permissible. But again, some of the issues I'll explain this in this session will cover things when you're engaging with a bank or putting your money into a money market fund. Some of the things you might want to consider around the third parties you're engaging with in order to look after your reserves. So that for me really sort of gives a little bit of the backdrop. And in essence, the two really important updates that have happened in the last 12 months or so, if anything, I could stop at the slide and walk away from here. But the two issues that, if you start to put your head into the ESG world or social investment world for charities, one is this now fairly infamous case called the Butler-Sloss versus Charity Commission. This is Dame Elizabeth Butler-Sloss, who is a trustee of the Ashton Trust and a number of Sainsbury family charities, that took the Charity Commission to the High Court, and the resolution of it, and I won't go into the legalities of it. If you Google Butler-Sloss Charity Commission, you can get all the legal jargon and guidance on this. But it's simply, the case was to say, if we want to exclude certain areas when we're investing, or we want to invest in a certain way that matches our charity mission that might have an impact on the financial return, because as trustees, as people investing money, your duty within the Trustee Act is to maximize the return on your investments. But if we want to do it in a social way, i.e. we want to, in this case, cut out fossil fuels, which may have a negative impact on the financial return of the charity, that's fine. So within the law, it has now been, again, clarified through this particular case that by investing socially and by reducing the potential for financial returns, that is absolutely fine. And the 2 points I make on this slide are very clear. You should really think about what matters to you as the charity. So invest in line with your charitable mission, and obviously different charities will have different missions in terms of what they're doing. And invest in what matters to your reputation, that is your stakeholders. So if you are a fundraising organization, you don't want to be receiving the funds and investing it in a way that will upset your donors. And likewise, if you're giving money away or you're spending it on beneficiaries, you don't want to be they don't want to be in receipt of money that is in sort of effectively tarnished. So an example would be a medical research charity that is investing in tobacco. Clearly, there are sort of conflicts in those sort of cases. So that is a very simple and helpful legal guidance for charities to think about when they're investing. And then the second point here is what's called CC14. And CC14 is the Charity Commission's guidance for charities investing. And that was updated actually only about a month or two ago. And again, the positive news there is that the guidance has simplified since its former sort of context. So actually it's much easier to understand and read. And what's specific and obviously notable for this talk is the wording around responsible investment. And the difficulty with social investment, E.S.G, mission related, impact investment, is there's so much jargon around this. But what the guidance says, and again, if you Google CC14, you'll get straight to the government, the CC14, the Charity Commission guidance on this, is that essentially it has said you can make a financial return, which is exactly what you should be doing, but also you can make a social return. And there's clear definition in terms of what they think is a social return. So the Charity Commission are also endorsing the fact that you can be investing on a social basis. So if we go back in terms of a little bit of the historical perspective on this, what this chart demonstrates, and this goes back to 1930, and it looks to a large extent in the US market, but it's what here is actually prevalent here in the UK and in Europe. And what this is showing you is the holding period. So this is saying if you invest into a company as an investor, a charity, it could be any type of investor, how long in years are you going to hold that investment for? And what you can see here through the earlier part of the last century, but certainly into the latter parts of the century and obviously up to the present date, the holding period of the average investor has come down dramatically to a short and very dramatic sense. So the holding period now is probably less than 1 year. And what that does is fine in terms of profit, because you might buy a company or buy an investment, hold it for less than a year, make a profit and move on. But what it generally means is you don't really participate in the company and what the company is doing. So the natural reaction or the natural fault of that is that you're not engaging potentially with the company. You're engaging with the profit, but you're not engaging with actually the company as a long-term investor. And charities by nature, because most charities are around in perpetuity, i.e. they have a very, very long-term time horizon, you have the ability to invest, if you are, into companies and use your share to engage. But you can only do that, obviously, if you're going to be invested in that company for a relatively long period of time. And we would probably think 5, 10 plus years is meaningful in that sense. So you can see how a lot of investors really have sort of switched off from engaging with companies. They're just there to make the money. And that's to a large extent changing, and you'll find that those people who are investing with a social purpose, and I'd say I'll come on to the definitions of this, will be generally buying and holding companies for 4, 5, 6, 7, 8, 9, 10 years and beyond. And in that way they can engage. So getting into the sort of the meat of this now, what is ESG? And for those who are familiar with this, this will be sort of second nature, but effectively, this is taking in the environmental, social, and governance considerations when making an investment decision. So when you start, let's say a charity starts with cash, you think you've got to make some investments, and it could be in stocks and shares, it could be in bonds, it could be in other assets. So you start to make that investment decisions. And then you think, okay, well, we know we need so many, so much percentage in these different types of assets. We think we might need some help in terms of the different companies. And everyone will have some degree of an understanding of that, but typically you'll delegate that to an investment manager who has that ability, and you'll be making that long-term decision. But increasingly now, and the guidance the Charity Commission give and the general way and the direction the world is going, is that you should consider the social, environmental, social, and governance aspects to your investments. And this chart, in simple terms, I hope simple terms, gives you really the way most charities go about investing. So, fundamentally, you start on the left-hand side, you want to make a sustainable investment. You want to be a good, responsible investor. And I say, trying to simplify the jargon on this, most investment managers and most of the industry and investments are not talking about sustainable investment. And obviously, you can apply the word sustainable to many things. So if you start at the top of this box, you've got traditional investing. That's a focus on financial returns. As I say, simply is that's what the Trustee Act 2000 tells trustees they must invest to maximize the return on behalf of their beneficiaries. But obviously, when you start to grade down and start to consider some of these ESG factors, you start to think about the things that matter for you. And I said on that previous slide, thinking about investing along the lines of the mission of the charity, but also in terms of the stakeholders that obviously are part of your charitable organization. And the two elements to think about, without getting into sort of complication of this, is the negative screening and then the engagement. And the negative screening, and I'll come on to this in a second, is thinking about those sectors or industries that are clearly to some extent sinful. And again, it's fairly subjective in terms of what's sinful and what's not, and we'll maybe discuss this in the Q&A. But there are clearly areas that from your charitable mission that you might want to exclude. So typically, if you're a faith-based organization, you may want to exclude things like pornography, or it may be things around birth control, or if you're, again, a medical organization, you would not necessarily want to invest in tobacco, alcohol, and other areas. So it's what's specific to your own charity is obviously very important, and you would want to some extent screen those out. I think where the world is going, having decided that, actually this whole element about engagement is becoming much more prevalent now with most charity investors. And this is simply by saying that if you want to invest, and you invest into a certain sector, country, or even company, you can use your share to start to change societal benefits. And the clear and obvious example of this is fossil fuels. So as we head towards the sort of Paris 2050 net zero targets that most countries and most people are aiming towards, although this country obviously is slightly challenged on this at the moment, but the fact is you want to head towards that net zero. It is actually quite difficult to completely screen out fossil fuels from most investment portfolios, because fundamentally we all have to heat our houses and we all have to drive, and products are made from oil. But the fact of the matter is you may want to buy some of these companies like BP or Shell, who are obviously fossil fuel production, oil and gas, but on the basis that you want to, I suppose, engage with the company through your share, with other charity shareholders, through your investment manager, to get the companies working onto a more sustainable and renewable path. And obviously the oil companies are on that sort of basis. So it may be, whilst you want to be net zero or aim towards net zero, you may invest into companies that possibly have a challenge against your mission, but as an engaged investor where you are trying to challenge them. And I'll come on to sort of the certain elements that you should think about that. And then the last element on this box is impact investing. And again, there's a degree of confusion about this, but generally speaking, we're getting into the realms now where you're making a social investment. You're making investment for a social gain. And again, the guidance the Charity Commission give is fairly simple, that it may be that you want to invest, and I know charities that invest into social impact bonds, where there is a potential of a financial return, but actually the balance is more for a social gain. And it may be around prison reform or preventing reoffending. It could be about homelessness or social deprivation, where there are these social investment opportunities that you can invest into, where the emphasis is on trying to obviously change societal problems, and also from the fact that, at some point you may not actually get a full financial return on that. So achieving that balance, and by nature of the fact it is impactful on society, that is more an impact investment. And obviously you go down that sort of green sort of ladder, if you like, in terms of where you are. And most charities will be thinking about negative screening and engagement, and that's certainly the area. So you're sort of sitting somewhere in the middle. The exclusionaries, and there's sort of, we put here 10 typical sort of sin areas. These are the types of exclusions that most charities would consider when they're thinking about their investment. And what's interesting is that if you went back probably about 50, probably 80 years ago, and you looked at let's say the UK stock market, or even the world stock market, 80 to 90% of the market would be made up of these types of companies, because that's the way the world was at that time. We were fighting world wars, notwithstanding the fact, obviously, we're fighting, challenging wars at the moment. But the reality is that actually, and if you look at we use example here of the global MSCI World, which is the global index or the global stock markets around the world, if you think of these 10 key exclusions, it only actually makes up around about 11% of global stock markets. So actually, if you were to exclude these areas from your investment portfolios, it's not going to have a material impact in terms of excluding. Clearly, the more you exclude, the more, I suppose, restrictive you make your investments. But the reality is that these are the areas you should consider. And as I said, it's quite difficult to totally remove them. So, for instance, tobacco, if you say, I want absolutely no exclusion, I want no exposure to tobacco, essentially it means that you can't have a supermarket, or you can't have an oil company, because supermarkets obviously sell tobacco, and people like BP or Shell, whatever, who have petrol forecourts will be selling tobacco through petrol forecourts. So you kind of think about, I can have possibly 10% of the overall revenue of each company that may have some impact. But obviously, if you're going to be very exclusionary on this factor, it will limit your ability to get that sort of spread of investment. But the point is now, the way the world is going, because the negative nature of a lot of these sort of sectors or industries is that they are generally being excluded anyway. And also the point I would make is that if your charity doesn't have an issue with this, and it could be, again, it could be a religious charity who have members of the order who frankly drink, is it necessary to cut out tobacco or alcohol in those sort of cases? So again, it's a judgment and of subjective judgments that you need to make for your own particular charity. When we think about the more positive elements, and this is going back to the E, S, and G, the environmental, the social, and the governance points, in very simple terms, from my point of view, and I think if you speak to people about this, it's really about planet and people. So the environmental elements are clearly around the planet, and you can see here we've highlighted a number of the issues that charities might want to consider. So if you're an animal-based charity or ecological charity, you're obviously going to be very clean on biodiversity, deforestation. Most people are now working towards the sort of climate change net zero. So these things are important from your point of view. And then I think from the people point of view, you then separate it between the social and the governance. And the social element is around how people are treated, generally speaking. So it's about human rights. It's about sort of supply chains to some extent. It's about how people are treated within workspaces and workforces. So you may be familiar with the case of Comic Relief, for instance, that was investing in to one of the clothing manufacturers that was using child labor in third world countries. Now, obviously, child labor for Comic Relief was a real cross between what they're trying to do and not. So it's going through those sort of principles that you've got to think about. And obviously the governance elements really relate to the types of investments. So the board, how the companies are managed, the directors of companies, is their independence. It goes back to some extent the technology companies that are majority owned by the founders. Is there impartiality there? Is there independence to these things? And I won't go through all the list here because you can read it for yourself, but ultimately what you're beginning when you're considering these factors is aligning your investments with your values. So it goes back to the value of the charity and what matters to you. And obviously the aim here, and we'll come on to look at this, is that by adopting some of these ideas within your overall investments, and I say it could be in cash because you're sitting and putting money in a bank or in a money market fund, where is that money sitting and what's happening with that money? And what's the bank organizing it? So it can be cash as well as long-term investments. But the aim is to create more positive social environment outcomes generally. And the world is going in this direction, not just for charities, pension funds, private investors are thinking along these lines. And I suppose the way the world is thinking around this, and there are a number, and I'll sort of come on to this in my penultimate slide in terms of all the different agencies and people out there who are trying to push this agenda on. But most people think about the UN Sustainable Goals or Sustainable Development Goals, and there are relatively simply 17 goals that people at the UN is now focusing on. And again, I'll leave that for you to look through. And again, for you as a charity investor, or you as an investor in general, each one of them, or a number of them, or all of them will be pertinent to you as an organization. It may well be that certain ones aren't. You don't necessarily need to worry about, life below the water, perhaps, but obviously that is an impact on the world. But from your charity's point of view, that may not be as a bigger issue relative to zero hunger and starvation in society. So again, you'll find that the tree that is based on this whole ESG world relates back to the Sustainable Development Goals that the UN is globally trying to transform the investment industry and get people thinking along the lines of. And this is in development. This is not hard and fast. This is changing, and each country will have different views on this. And I suppose the live case as we're heading to election in the United States is that each state in the US, be it a blue state and a red state, have very strong views around these different factors. So it can get quite political in that sort of sense. And obviously, we are bringing the third world to some extent, the developing nations, the southern countries who are clearly financially don't have the economic ability to change these things. But the aim is to get the developed countries to sponsor some of these initiatives. So we work on a global basis. Enough of that. So to try and give this a sort of a little bit of flavor in this, if you start as an ESG investor, some of the impacts that you get are actually quite powerful and very, really thought-provoking. And this is where the world will change. This is where we'll get to the point of getting to net zero, hopefully at the end of the day, by everyone trying to address this in line. So there are, as I've just mentioned, thematic approaches to this. So there are thematic approaches about water production, around climate change, around people, So these elements of thematic will feed through into the investments that you hold. And obviously there are trends. These are trends. We are all trying to get to net zero. So you are following these things. And the reality is that if you invest into renewable energy over the long term relative to oil, which we all hope is going to be an orphaned asset at some stage, we shouldn't be using oil, the development of the share and the return is probably going to be more beneficial in these more sustainable ESG elements of investment than it will be in the old, say, sinful type of parts of the society and the economy. And as you move around this sort of clock, you can see where if you integrate the ESG factors, you become an active owner and you engage with companies through your shares. You vote at annual general meetings against excessive pay or other factors that organizations are trying to sort of employ or get through in their systems. Ultimately, the impact on society is going to be much greater. So the long-term enhancement for returns by investing on an impactful basis is actually going to be very positive. So there is going to be actually generally quite a strong financial return. It's going to take a long time over the fact that actually we hopefully will have a better society as a result of this. And just to put this into perspective, there is this sort of debate that actually if I exclude and I become a very social investor, I am going to give up on my returns. And if I'm honest, there is not deep enough statistical evidence to prove by being a good investor that actually you will impact your financial returns. But I thought this was interesting, and this slide and this chart looks at returns certainly for the last 10 years. And what this is the global equity performance. So the blue line, the top line, and this is the MSCI World SRI. So it's excluding some of those sectors that I put on the previous slide. So the things like armaments and tobacco and other elements. And then it charts it against the if you like, the clean MSCI World, that is, the straight, unsocial, unsustainable sort of index. And then it's against the FTSE All Share, which is basically the UK equity market. So over the last 10 years, by being a social investor, you actually exceeded returns to August 2023, which in my mind demonstrates that by being a social investor, by thinking about impact and by being an impactful investor, it doesn't necessarily have to impact your financial returns in that case. And what's interesting, if you look at the world versus the UK, a large part of the UK underperformance, unfortunately, is because if you look at the UK stock market, there's a fair amount of oil and gas producers in the index, Shell, BP. There's a fair amount of industrial metal companies and armaments companies within the index because they just happen to be listed in the UK, notwithstanding there will be a Brexit impact on that. So I hope that just demonstrates being an impactful investor shouldn't necessarily have a detrimental impact on your financial returns. I think one of the biggest problems here is how to measure this. And as I mentioned, this is a growing area. And one of the biggest challenges, and I'll be honest about this, is that if you want to go down this line and you want to be able to demonstrate to your stakeholders that by excluding certain areas and by engaging as a shareholder, what does it mean? What impact is this? The difficulty at the moment is that although the UN and different countries are moving in this direction, there isn't at the moment a clear, globally at least, identified framework in terms of how to measure this. So for those charities that have to comply or have to report a financial return each year, you'll be doing your report and accounts and submitting that to the Charity Commission. And for charities of a certain size, that will obviously be an audited accounts in line with the financial guidelines and your SORP. There is an internationally recognized way of reporting your accounts, like it or not, and as a charity, that's very clear. Within social investment, within investment full stop, clearly you'll get a valuation from your investment managers saying how well you've done or not, and what your financial returns are. But there's no clear model in terms of how to measure this. And you'll notice as someone rather cynically said, all these different Boy Scout badges or Girl Guides badges that you will regularly see in investment manager literature. These are different organizations around the world that are on side and are trying to move the whole charitable, not just charitable investment, but sort of investment, social investment, ESG investment across the world. But the difficulty is there's no common measure of this. Certain managers, investment managers, are very forward thinking on this, and we certainly, I think it'd be difficult to find, and if you speak to any investment manager, certainly in the UK at the moment, and start talking about this, there isn't, or certainly not very many managers that are really all over this, and they are taking this very, very seriously. But for you to get that measure in terms of what is my imprint in terms of being a good investor, there's no clear method. A lot of investment managers will produce an annual report, as indeed most listed companies have to produce a report in terms of their E.S.G, their carbon footprint, how they're dealing with people, all the elements I've highlighted on previous slides. But don't worry if you do struggle to get that information, and it is evolving, and we're getting closer. The European Union, the regulators in the European Union are working very strongly on this, as indeed are here in the UK. The US, as I've slightly mentioned, are there, but they're slightly behind on this. But we're getting to a point where there's going to be unification in terms of measurement on this. And it's something you've got to appreciate and not worry about at this stage. And I think my sort of penultimate slides now really focus around those organizations that are leading on this, because I think in my conversation with a lot of charities and those charities who come to us at Charity Intelligence and ask us, where do I start? How do I do this? We don't really understand. I've tried to give here examples of UK charities that are really leading the charge on this. And I've given an expression from E.S.G Fairbairn in terms of how they think about this. And it's probably unfair to a number of the people on this call to sit there and say, if you look at the list of these organizations, they are, let's face it, quite large charities, quite large foundations who have been at this for quite a long period of time, who've got their in-house resources to really focus on this, who are leading on the charge. I understand that and I accept that. But actually, they are useful models, and by all means, look at their websites, look at their reporting accounts to give. They do give pretty clear indications in terms of how they're thinking about it. And I always say to charities, don't be afraid. Look at some of those organizations that are forward thinking on this and learn from example. And if you certainly speak to people at Joseph Ramsey, for instance, who obviously have a Quaker-based approach to life, and they've always had a very sort of sustainable, responsible approach to investment, they're very happy to share knowledge and information on that, and there are quite often a lot of resources. And if I go back one slide, at the bottom here you've got the Charities Responsible Investment Network, which is derived through an organization called Share Action. That again is a collaboration of these types of charities and these types of organizations helping UK charities move on with sort of ESG and social investment. So there are clearly organizations out there who are there to share best practice in this area. So to conclude on my presentation, the key takeaway from this is, by being an ESG investor, should I be thinking about profit or purpose? And the answer is very clearly, and the Charity Commission has made this very clear in recent weeks, it's both. Yeah, you need to create a financial return, but if you want to invest that is in line with your mission and your stakeholders, that is responsible for you, which might have an impact in your financial returns, legally and from the Commission's point of view, that's absolutely fine. As I think you possibly conclude from this, it's not straightforward. If you start to embed ESG into your investments, or in fact, actually all matters of how you invest or how you deal as a charity, how you employ staff, how you thinking about your own premises if you have properties, and how you're trying to get to the ESG ratings that are coming in, all these different factors, it's not simple. But the thing is, when you're trying to embed some of these things, is to try and keep it simple. And if you're starting from scratch, don't expect to get to the perfect solution tomorrow. It just, I'm afraid, won't exist. The Charity Commission does encourage you to have a statement, not just an investment policy statement, but to have an ethical or a social investment policy statement. And I know a number of charities that we've been dealing with have decided, actually, do you know what? we don't really need to have any exclusions because the nature of how we operate as an organization, it doesn't matter for us. But clearly we want to be a responsible investor, but develop it over time. Please don't expect the fact, or don't feel that you're under great pressure to come up with the perfect solution, and evolve. And each year keep it under review. And if you are engaging with fund managers and investment managers, or even your bank, talk to them about that. They are generally very helpful and very keen to support you on your ESG mission. Thank you very much. I'm going to stop sharing there, and I think we're going to open it up for questions.
Yeah, that's great. Thank you so much, Guy. Now, we've had a few questions come in already, but I just did want to signpost to everyone that if you have any other questions, feel free to add them in now or upvote the existing questions, as I'll be addressing these from the most upvoted first. So the first question is from an anonymous attendee asking, how do we avoid greenwashing? Do we need to wait for the labelling of investments to become more standardised or regulated? And they added in an example of how to find the best green fund.
It's a very good question. It's something that crops up the whole time. And for those who probably fairly unfamiliar with the greenwashing concept, it's this idea that we have an investment, or we have a company that says it's doing all good stuff, and it's a really sort of it's carrying out all those ESG elements that I pointed out, but actually when you really drive into the detail of it, it's not. It's essentially a marketing spin. It was a bigger problem in years gone by. The regulators are really getting on top of this now. There was a case recently in the US where the American Stock Exchange have sued, or at least fined, one firm for, in all intents and purposes, greenwashing, mis-selling in this case. I think what you'll generally find for most investment firms now is that they are, because they don't want to be full foul of the regulator, that they are fairly clean of this concept of greenwashing. And it's only down to when you start engaging with investment managers that you will understand, because you'll see the resource they have that they're applying towards this whole principle, and how the ESG, so these elements I've described this afternoon, how that's embedded within their investment process. So it's only by engaging with the fund managers that you will understand their commitment to this, and the reality about greenwashing or not. And the last thing I'll say is that the slide I put on, in terms of the fact there are so many organizations, it's very difficult to get true transparency, because there isn't a globally recognized accounting principle for this. It is something that you've got to take slightly with a pinch of salt, unfortunately, in this case. There are good funds, to finish off your question. There are good funds out there. There are specific firms such as Impact's Investment and others out there who are very, very firmly invested just for a social gain. But it does take quite a lot of research and help, and we could happily signpost people in that direction.
That's great, thank you. And I'll definitely add in your link to the slides and resources tab, so everybody should be able to reach the Charity Intelligence website very easily.
Thank you.
So the next question is also from an anonymous attendee asking, do we need to have an ethical investment policy for our charity?
I think it's likely to make that nuance at the end of my presentation. The answer in real terms is yes. And if you look at the Charity Commission guidance, CC 14, excuse me, it does encourage charities to incorporate, or at least have, not just an investment policy statement, but to have a social investment or an ethical investment policy. And as I mentioned, it's quite nuanced between different charities, because as I mentioned, there are certain charities, it could be a military charity, for instance, that obviously their beneficiaries, if they are dealing with veterans, and it's a world I know well, they smoke, they drink, unfortunately probably use pornography. The organization and the background to it is armaments. So if you think about all those different sinful areas, actually they decide, well, we don't necessarily need to exclude, but we want to be. I think you need to make a statement that you are a responsible investor. And even if you decide you don't necessarily want to get particularly green in this, you'll find that when you start engaging with fund managers, it's almost impossible not to have some exclusion, or indeed focus around net zero. So I would argue, yes, to have an investment, an ethical statement, but keep it simple. You don't necessarily need to get into great debate. It's really subjective, unfortunately, because it's what matters to me and you and everyone will be very different, and obviously what matters to your organization will be down to the organization and the mission.
Yeah, thanks. That was a great answer for quite a complex question. The next question is from Joyce, who asked, are there concise resources for charities on how to link their mission and investment strategies to net zero targets?
Ooh, good question, Joyce. The simple answer is no at the moment. There aren't clear resources. Hopefully you'll have the slides afterwards, and you can look at some of the links I made in terms of the organisations. The Net Zero Initiative, I think, is a really good element. As I mentioned, there's organisations such as Share Action, who are working with investors from a UK perspective to get people to think about these elements. I think the only thing you can do in terms of a positive link is to probably work, if you are making investments, is to work with your investment manager to try and get them to identify the impact of climate and carbon, because I think a lot of managers now are able to make some measurement. Again, I will try and be, sort of not trying to be so cynical about this, but of course, in most cases, they themselves, the investment managers, are using third-party entities such as Sustainalytics, MSCI. So there's a whole load of people. It's all down to data at the end of the day. So you may be investing into a bank that is trying to offset its carbon, and how does that impact your portfolio, and how does that impact you as a charity? It's confusing, I have to be honest, at this stage. There's not a simple resource, unfortunately, but it's engage with the right people, look at some of those resources, and develop it over time.
That's great, thank you. Yeah, definitely a hard one to get your head around and connect all the dots.
Yeah.
The next question is, how do I start to engage my charity stakeholders on social investment without causing chaos?
We get this a lot. I have to say, it's one of the issues that sort of comes up. And I'll come to probably an example. I think the answer to this is that the discussion starts with the board, because ultimately it's the trustees, the board's decision. And obviously, if you have employees or senior leadership team, depending on the size of the organization, it's at that level you start to have this discussion. I've had probably about 5 different chats with charities in the last week about this, so it is quite a live thing. Often, and especially if you get into the sensitive areas such as animals, you get into such as ecology, elements that really people have great passion about, that you may want to go out to your members or your stakeholders, that could be beneficiaries, supporters, obviously donors, and engage with them. But the difficulty then is, it goes back to the subjective nature, is that everyone will have a view, and the more militant people out there will have a very, very strong view, and you can get very sort of tied up in the weeds on this. So the example I would give is a higher education organization, a university, who obviously has a student body who naturally and rightly has passion around climate change. And the point, and certainly the examples we've had in the past, is you need to engage with them, but probably a subset. Don't try and engage with everyone. So if you're the RSPCA, don't try and deal with all the membership. It may be something you bring up at an AGM if you have an annual meeting with your members or your stakeholders. But I think, again, it goes back to the pragmatic nature. Just, you've got to start and then develop it over time. I think the important part to some extent now is to, if you are engaging with this and your investments in general, is to probably make some statement in your annual report. If you're making an annual report, you need to do so. So you could put it in the trustees' return in the annual report, saying this is what we are focusing on, and obviously react to this. The main element is to try and avoid the front page of the Daily Mail. It's the classic example where the church commissioners were investing into Wonga, the day pay lending service, because they happen to be investing into a fund which within the fund had that exposure. And obviously that sort of hit the front page of the Daily Mail or the Daily Telegraph. So there is that reputational risk to it. But again, don't fear at this stage. Take it pragmatically and develop it over time. What you shouldn't do, sorry, I'll finish off a long answer, is to essentially capture everyone's view, because what you'll generally find is that somebody will have a sensible personal view on certain company or certain area, such as how dreadful Tesco's are to their staff and tracking staff, therefore we shouldn't have Tesco's. If that's what the mission of the charity is about, treating staff sensibly, and it's a very valid and a very normal thing to want to make Tesco a better employer. But if it's not pertinent to your charity, you shouldn't be excluding that. But it gets very confusing. Take your time and do, be pragmatic.
Yeah, and don't try to tackle everything at once.
Exactly that. Less is more.
Yeah, and that actually leads us perfectly on to the next question, which states, how do you sell this into the senior leadership team who are very risk adverse?
Now that's a great one. I think again it comes back to this sort of mediation factor, and it's really interesting that the more you start to think about this, the more it becomes important to individuals. And ultimately, at the end of the day, a charity is made up of people, and it's made up of money or assets, property, whatever it happens to be, and it's how the two manage, well, how the people manage the assets. So trustees obviously have the ultimate responsibility for making these decisions, and they rely on the senior leadership team to carry it out. If there is a disagreement between the board and the SLT, that's obviously something that the chair probably, or if there is a treasurer, needs to take control over, needs to sort of lead on. And ultimately, like any disagreement or dispute that within any organization, you need to probably get somebody to come and mediate or find some way of mediating that. And it may well be an independent person, consultant or somebody to try and come to some degree of resolution. But it is, as I say, the more emotive the organization and the cause and what you're doing, the passions will start flying on this. I tend to find, just to finish the question, that it's the SLT who tend to be more want to take the risks. It's the trustees who are risk averse, but everyone's different.
Yeah, no, very interesting take on it, especially seeing as that question was posted anonymously, so they we don't want to find out who that was.
And the other thing is that people just don't generally want to air their dirty washing in public. So if you can try and resolve these, and in fact the Charity Commission, not on ESG, but they're getting more and more referrals from charities where there are disputes in charities that actually could easily be solved by the lawyer, the investment manager, or obviously just a sensible discussion on the board. So people are referring themselves to the Charity Commission because they can't solve these simple problems. But it's a human problem rather than an unsolvable problem.
Yeah, wow, lot to take in there.
Yeah.
And then the final question we have, unless anyone has any more to quickly submit in, is also from an anonymous attendee saying, thank you, Guy, for your presentation. My question is about a fund focused primarily on returns, exploring shifting to responsible investing or even impact investing. How would you advise on enabling or assisting them, the fund, the partners, the investment and the deal team, to culturally and behaviourally adopt and assimilate this into their investment process, but also to be more impact-minded in their approach?
Yeah, no, again, I've dealt with a number of organisations and continue to deal with this. I hate to go back to my general gist on this. It's a path you need to start walking down, because there isn't a clear solution in this. To try and make some clarity, because again, it's a big question for which I'll inevitably, as you're realizing, I tend to give big answers. Is that the general charity investment world is absolutely on this case anyway. It's working this thing. So for those of you who'll be unfamiliar, a growing number of charities tend to invest through what's called a charitable authorized investment fund, a CAIF. And on our website, we have a quarterly report that sort of looks at each of these types of investments. And we're working with the Iris Foundation to give clarity in terms of the E.S.G. So you should be able to look at the financial returns and all the elements of this, but also at the same time, where each of those firms and each of these funds are excluding and engaging in these sort of elements. So there should be more clarity on that. And that's, again, on our website. So that helps. And that, for most people, most charities, that is, solves the need of having a longer term investment that is diversified with a financial gain, but then a balance with the with the ethical elements that I've discussed this afternoon. When it, as I mentioned, that slide that started on the red, as in financial gain, and you went down further green down to the impact element, that for me is really interesting. So quite a number of those charities I listed at the end, certainly E.S.G, Fairband, and Roundtree and the others, are really leading the charge in the UK of investing on this impactful basis. And that's to say, as I mentioned, examples of social impact bonds that are structured like any bond. So you basically lend the money it'll be somebody like Social and Sustainable. There are organizations out there, Bridges Ventures, Big Society Invest, Big Capital, Big Society Invest, Big Issue Invest, sorry. So there are organizations out there that create a financial investment, so like a bond, and they will use the returns to tackle a particular problem, as I mentioned, homelessness or lack of reoffending. And you, in theory, get your money back like you would from any bond at redemption, and then you reinvest that point. The difficulty is that market is really quite small, certainly in the UK. And for most charities, finding the opportunity to invest in these social impact type investments is quite challenging. But I mentioned social and sustainable. There are a number of organizations out there, which, again, if people want to come back to me afterwards, I'd be happy to signpost them too. What we are seeing, interestingly, with a number of organizations that want to go down this route is they will say, okay, we may have £1 million that we're investing, but we want to put some money towards this. And let's say it's going to be £100,000, which actually, if you think 10% or thereabouts, is quite a large part of it. It's generally around about 5% of their overall reserves they might decide they're going to do in this social investment world. Obviously, that's not going to turn the dial really very much. That's not going to make a big change. So what we're tending to find now is that charities who work in the same area, so it could be homelessness, it could be medical research, whatever it is, your particular niche, you'll know other organizations who work in the same sector, same part of that sort of charitable sector, who you may decide, well, actually, if we join forces and combine, and each of us puts in 100,000 to make that million, for instance, and we'll invest in that way. And again, there is that sort of, force multiplier in a way that is going to push this whole agenda along. The difficulty is when you're thinking about this as an organization, when you're making these impact investments, it's a long-term thing. So if you remember that chart at the beginning, which showed financial investments, the holding period was less than a year. Whilst that's frustrating, if you're going to make an investment into a social impact type solution, you've really got to be thinking around about 10 years or more. You've got to be thinking that the ability for these structures, the ability for these types of investments to actually have a financial gain and to be measurable is going to take a number of years. So if you allocate some money towards this, which obviously is quite a big debate within the board, and it won't be a lot of money compared to your overall reserves likely, that you've effectively got to lock that money away and not forget about it, but just appreciate that that is money that you don't need a financial gain on in 10 years. And the hope is that you'll get the money back and you'll be able to measure the social gain and impact of that, and obviously be able to further. It's all about furthering the mission of the organisation and what matters for you. And we are seeing, the good news is we are seeing more charities thinking along that line. So it's great to have that question.
Great, and really ended it on a positive note as well.
Good.
So that was actually the last question, and we only have a few minutes left in the webinar anyway, so it gives me a perfect amount of time to really say thank you, Guy, for joining us today, and thank you to Charity Intelligence for sponsoring and making this session possible. If everyone who attended today could please share their feedback, that'd be fantastic. I've just pasted a link in the chat, and you'll also receive a prompt just after you leave this page. And finally, our next webinar is next week on the 18th of November on the best practices in cybersecurity, presented by Avast Business Antivirus. And we still have many more webinars upcoming as we produce these every 2 weeks. So make sure you keep an eye out on our website for anything coming up. And yeah, thank you once again for joining us today. Bye for now.